What's happening right now isn't a theory, a prediction, or a distant possibility. It's already in motion. While most people focus on inflation headlines, interest rate rumors, or the next market swing, the financial system itself is being quietly rebuilt underneath everything we use every day. As this video is being made, more than 130 countries, representing roughly 98% of global GDP, are developing or piloting central bank digital currencies. China's digital yuan has already processed close to $1 trillion in transactions. India's e-rupee grew more than 300% in usage in a single year. In late 2025, the International Monetary Fund released a policy framework explaining how these systems can be integrated into existing monetary infrastructure. This isn't speculation, it's coordination. At the same time, global debt has reached historic levels. Worldwide, government debt now sits around 93% of global GDP, well above $100 trillion in absolute terms. That number matters because highly indebted governments always face the same constraint. They need to reduce the real value of what they owe without triggering social unrest or economic collapse. Historically, they rarely pay it back outright. Instead, they dilute it. After World War II, the United States reduced its debt from 106% of GDP to around 23% over 3 decades. That didn't happen through budget surpluses. It happened through controlled interest rates, moderate inflation, and restrictions on capital movement, a strategy economists now openly call financial repression. The UK followed a similar path using nearly identical tools. Today, the same pattern is repeating on a much larger scale. In many developed economies, interest rates sit below the real rate of inflation. When inflation runs at 6% and savings earn 4%, purchasing power shrinks every year. That loss compounds quietly. A 2% annual erosion doesn't feel dramatic in the short term, but over a decade, it reshapes retirements, lifestyles, and social mobility. This isn't accidental, it's structural. To make this concrete, imagine someone who saved $50,000 over 10 years, believing they were being disciplined. On paper, the balance still looks respectable. But if inflation quietly outpaces returns, that money might only buy what $40,000 used to. The effort was real. The discipline was real. The loss came from the system itself. Financial repression only works when people stay inside the system. As long as money can move freely, be stored in alternative assets, or transferred across borders, control remains incomplete. That's why the current shift isn't just about modernizing payments or efficiency. It's about building a system with visibility, enforceability, and reach that previous monetary frameworks never had. And this transition is happening while daily life appears normal. Markets still open. Salaries still arrive. Spending continues. That sense of continuity is what makes this phase so dangerous. Major financial resets don't begin with chaos. They begin quietly, with infrastructure. Once governments reach debt levels this high, the range of outcomes narrows. History shows that when obligations become unmanageable, states don't suddenly become disciplined. They change the rules. The mechanism they rely on is subtle and legal, keeping interest rates below inflation while encouraging people to hold wealth in forms that are easy to measure, tax, and dilute. This is how financial repression works in practice. If inflation averages 6% and conservative assets yield 4%, the real return is negative. Savers lose purchasing power even as account balances appear stable. Over time, that loss becomes a transfer of wealth away from households and toward debtors, primarily governments. This is why large debt burdens often shrink without explicit repayment. The currency weakens instead. What makes the current moment different is scale. Global debt isn't confined to a single country or post-war rebuilding effort. It's systemic. Developed nations, emerging markets, and once conservative economies are running persistent deficits. At the same time, populations are aging, entitlement costs are rising, and productivity growth is slowing. Policymakers are left with very few painless options. In the past, financial repression had a weakness. People could opt out. Capital could move offshore. Wealth could be stored in foreign currencies, precious metals, real estate, or alternative systems. Physical cash existed outside databases. Control was partial. That escape valve is exactly what modern monetary infrastructure is designed to close. When money becomes fully digital, programmable, and centrally issued, the system gains something it never had before: complete visibility. Every transaction leaves a record. Every account exists within a controllable framework. Policy no longer relies only on incentives. it can be enforced directly. European central bank officials have openly discussed the strategic role of a digital euro in strengthening monetary sovereignty. China already runs cross-border settlement trials between Hong Kong and the mainland using digital currency rails. These aren't experiments in convenience, they're proofs of control. Once visibility exists, extraction becomes easier, taxes become harder to avoid, capital controls become enforceable. Behavioral rules can be built directly into money itself. At that point, holding wealth purely in cash-like instruments stops being conservative. It becomes exposed. And this exposure doesn't hit everyone equally. The system naturally looks for the easiest places to extract value. Cash balances, savings accounts, pensions, bonds, and fixed income investments sit directly in the line of sight. They're simple to measure, easy to track, and politically convenient to target. Before we go further, if you are enjoying this video so far, consider giving it a like. It really helps the channel and tells YouTube that you're interested in this kind of content. Now let's continue. When a retirement account earns 5% while real inflation runs closer to 7%, the loss isn't bad luck. It's policy working exactly as designed. The statement still grows, but the lifestyle it's meant to fund becomes harder to maintain. Over time, people are pushed to work longer, save more, or accept less. This also explains the growing political focus on wealth taxes, unrealised gains, property levies, and expanded reporting requirements. Governments don't tax what they can't clearly see. The more transparent and centralised the system becomes, the broader the tax base grows by default. Visibility precedes extraction. Meanwhile, those least worried about this aren't holding large cash balances. Ultra-wealthy individuals typically keep only a small liquidity buffer for expenses. Most of their capital sits in assets that respond positively to currency debasement. When inflation rises, those assets inflate in nominal terms. A $500,000 property doesn't suddenly become more useful, but its price rises because the measuring unit weakens. You can see this divide clearly during periods of instability. One group experiences rising costs and shrinking options. The other sees asset values adjust upward. It's the difference between holding the ruler and being measured by it. Institutional behaviour reflects this logic. Sovereign wealth funds, corporations, and long-term allocators aren't retreating from scarce assets during uncertainty. They're increasing exposure. These moves aren't driven by fear or headlines. They're driven by structure. When systems come under stress, the difference between those who struggle and those who adapt isn't intelligence or luck. It's dependence. During the Great Depression, families who relied entirely on wages and centralised supply chains suffered the most. Others survived better because they controlled essential inputs: food, shelter, skills, and community support. Fast forward to 2008, and the pattern repeats in a modern form. Many avoided the job market entirely, flooding graduate programs and delaying entry into a weak economy by taking on debt. That worked only because the system itself stayed intact. Credit was available, institutions functioned, infrastructure held. The risk today is assuming those same escape valves will always exist. A reset driven by debt, inflation, and centralized control doesn't behave like a normal recession. It limits options rather than expanding them. When liquidity tightens, assets are repriced quickly. Retail investors are forced out first, not because they're wrong, but because they lack staying power. This is why uncertainty often benefits large institutions. When confidence breaks, liquidity dries up. Those with capital accumulate assets at lower prices while others sell to meet obligations. It's not coordination, it's structure. So what does adaptation look like in practical terms today? It starts with reducing single-point failure. Relying on one paycheck in an environment where purchasing power erodes is a structural weakness. Building even a modest second income stream, freelancing, consulting, digital products, remote work, adds resilience. Not because it makes you rich overnight, but because it gives you optionality. It continues with asset alignment. Assets that protect purchasing power share common traits: intrinsic value, limited supply, and resistance to direct debasement. Productive real estate generates income and adjusts with prices. Profitable businesses pass costs through to customers. Gold grows slowly. Bitcoin's supply is fixed. These aren't speculative bets. They're defensive positions in a system designed to weaken currency. Cash still matters, but only for liquidity. Beyond short-term needs, it becomes a wasting asset. Bonds may feel stable, but when yields lag inflation, they lock in real losses. Volatility is temporary. Debasement is permanent. Confusing the two leads to decisions that feel safe while quietly compounding risk. Efficiency also becomes leverage. During past crises, families survived by eliminating waste and focusing spending on what produced real value. Today, that might mean cutting unused subscriptions, reducing lifestyle inflation, and redirecting savings into assets or skills that compound over time. The modern equivalent of a thrift garden isn't growing food, it's building something you control. Businesses that survive resets don't wait for clarity. In 2008, companies that emerged stronger obsessed over cash flow, cost structure, and strategic positioning. They used crisis as a forcing function to become leaner and more resilient. The same mindset applies individually. Finally, there's jurisdictional risk. History shows that currency crises are often followed by capital controls. That's why high net worth individuals diversify not just assets, but access. Multiple banking relationships, international brokerage accounts, digital business structures, and residency options. These tools are no longer exclusive, they're becoming baseline risk management. The hardest part of preparing for a reset isn't the strategy, it's accepting that the system doesn't exist to protect your savings. Governments act to preserve stability and solvency, even when that conflicts with individual outcomes. Once that reality is understood, decisions become clearer. The financial reset won't announce itself, it's already underway. Millions will remain positioned for a system that no longer exists. Others will adapt early, quietly, and deliberately. The difference won't be predicting headlines. It will be understanding how value moves when money itself changes, and positioning accordingly. If this video helped you somehow, take a second to hit the like button. It really supports the channel. And if you want to keep learning how to build long-term financial stability in a changing world, subscribe for more videos like this. Thank you for watching.